However, I'm pretty confident that the gold price is going to break out for a number of reasons, not just the Fed, this ongoing central bank demand, falling supplies of gold around the world, all these different things. I think we're going to finally break out of the range next year, get above 2,100. It's been my experience in all of my years of stocks and commodities. Anything that breaks out to a new all-time high generally rallies just on average 10%, not hard and fast 10%. Some go 6, some go 14, whatever, but on average about 10, just on the positive momentum of the whole thing.
In the past couple of weeks, gold futures have surged 3% and briefly breached a key psychological threshold of $2,000 per ounce on Tuesday. To be sure, different datasets have different record highs for gold, but they all go back to 2020. According to Dow Jones Market Data, the intraday high is $2,089.20. For Refinitiv, it's $2,072.50, while Bloomberg puts it at $2,075.47. CraigHemke, a renowned founder of the TF Metals Report, foresees gold to surpass $2,100 with a 10% rally and envisions silver reaching $30, attracting funds for a 10 to 15% increase. Meanwhile, Craig notes seasonal gold trends, citing increased Indian gold imports during weddings and a shift to silver when gold prices rise. India's October gold imports surged 60% from a year earlier to a 31-month high as a drop in prices ahead of a critical festival prompted jewelers to ramp up purchases, a government source said on Monday. Indian silver consumption is forecast to surge by around 80% to a record this year as traders draw down inventories in warehouses from London to Hong Kong after 2 COVID-riddled years. He predicts a year-end surge with a dovish Fed, but expresses concern about underperforming mining shares. Gold hit 61.8% retracement, yet miners failed to reach even their 38.2% retracement. In other words, miners seriously underperformed gold. This is no small stuff. This is a significant indication that the big trend remains down. On the other hand, CraigHemke also suggests that investors, particularly those interested in physical silver, should consider the potential correlation with gold's performance. Now, we present the clips of CraigHemke's insights from his recent interview with Liberty and Finance. Before we continue to delve into this discussion, please subscribe to our channel and activate the bell icon for timely updates.
We've rallied really, really well over the last month. Some of it, the Israel-Gaza thing, but most of it is this change of financial conditions, easing of financial conditions with the dollar coming down, the stock market going up, bonds rallying. And that has bled over to this almost 10% rally in gold. I mean, gold now is, was about what, 1830 back at late September, early October, and now it's 1970 or whatever it is, and up on the year. I mean, we began the year at 1830. So we're back to being a typical year in gold, about 9 to 10% return. And again, you mentioned the shares too. The issue that it's struggling with, at least here in the back part of November, we saw, at least to my eye, a deliberate attempt to keep gold price down back on Friday when options were expiring on the GLD and the SLV. I'm writing about that today for Sprott Money. And pretty soon, next week, we get the front month December contracts. Those have volume and open interest all year long, and they will go off the board, and the options will expire next week. So we're probably kind of swimming against that for the next week. But once we get into December, the next jobs report will probably be weak. Seasonally, all the seasonal and birth death adjustments for November and December are weak and small. And so the next jobs report is probably going to be weak. That'll probably allow the Fed to be kind of less hawkish, a little dovish by the time they meet again in the second week of December. So I think the stage is set for a year-end rally. You mentioned the miners. Here we are again, another year where the mining shares are underperforming everything else. There's a reason why gold is seasonally, the gold price is seasonally strong in December. And one of those reasons is the seasonality of Indian imports of gold, because the wedding season in India is in the summertime. And so imports typically surge in December and into January in preparation for that. Okay, now further, what we've also seen is when gold prices are high, there's a shift often, just like anybody else. You shift into silver instead because it's more affordable. So the fact that Indian silver imports are rising and surging here in November and then into December of this year, that makes total sense. Now, bringing that back then down to just gold and silver prices going forward. Think of that Indian thing as like like an Indian physical metal gold silver ratio, right? As gold prices goes up, it makes silver look more attractive to Indian buyers. Well, a lot of people trade that here in the West. They look at that gold silver ratio and go, when it comes down, maybe I get more gold. And when it goes up, I get more silver, that sort of thing. As this then relates to the silver price, it drives me crazy, drives everybody crazy, right? Gold above 2,000 at the end of the year or above 2,100 in January. Oh, gold, new all-time highs. And everybody starts calling their stockbroker, hey, I got to get some of this gold. It's a new all-time highs. What's going on? And so it kind of feeds on itself. Let's just say my target for this year is met sometime next year in the first half of the year at 2,300 for gold. Let's go back to that gold silver ratio. Is the gold silver ratio going to go to 100 because gold's at 2,300 and silver's at 23? Nah, probably not. So as frustrating as it is to watch silver, if I'm right about gold, silver is eventually going to play along. And the same thing's going to happen there. Silver is going to get above 28 and 29 and finally be breaking out. And people are going to start getting interested. And the funds are going to come back to trading the metal on the COMEX, which they've avoided now for a couple of years. And you're going to start having a 3 handle. And all of a sudden it's going to do its own 10, 15%. And then that'll impact the miners too. So I hope I made that a kind of where all that kind of stuff could tie together. At the end of the day, like I said, where Indian gold and silver buyers are kind of playing their own gold silver ratio, I think silver investors, anybody looking to buy physical silver, calling up Andy at Miles Franklin and having him get you some, should look at that and think, okay, if we're right about gold, then now's probably a pretty good time to buy silver too.
During the interview, CraigHemke discussed the relationship between actual interest rates and gold, highlighting a discrepancy where gold costs more than $1,200. The price of gold has also been propped up lately by market uncertainty about whether the Federal Reserve would raise its benchmark interest rate again to fight inflation, said Joe Cavatoni, chief market strategist for the World Gold Council. He further emphasizes the substantial increase in debt and the consequential surge in debt service costs, pointing out the gravity of this situation. The U.S. Congress is facing growing calls to find a way to stem rising budget deficits and debt, following this month's warning by Moody's that political dysfunction could lead it to lower the federal government's credit rating. Let's get back to the interview.
There's a lot of talk over the last 6 weeks or so. What's going on? There's a long-term relationship between real interest rates and gold. And you've probably seen the charts. People listening to us have seen the charts. They move in tandem, and all of a sudden they go like this. And by that chart, with where real interest rates are, at least in terms of inflation expectations versus the nominal rate, you would think gold would be like $1,200. It's not. It's almost 2,000. What's going on? It's not fear in terms of, oh my gosh, I'm going to lose money. It's fear of missing out for that next rally when the Fed turns the spigots back on. I think that's absolutely the same is true in the stock market. I've always written about the end of the great Keynesian experiment, this exponential explosion of debt and debt service costs and how that just, leads to a rapid, and we're getting there now, finally, 12 years later, right? I mean, the debt service line item on the U.S. budget is now $1 trillion a year. So we're just finally getting there. So I've been right the whole time about this. You just don't know how long it's going to take. And so when I say this year's kind of a microcosm of that, that's kind of the same thing. I mean, everything I wrote about back in January, I still believe in, and I still was, I think, right. It's just like 6 months behind schedule. It's just taken a little longer. And I don't mean that as an excuse. I'm surprised myself that the data kind of has held firm, the data that the Fed looks at. And some of it actually seemed to improve a little bit over the summer. When we got FOMC meeting in June, even the FOMC members were talking about rate cuts maybe as soon as December and 4 rate cuts in 2024. That's what the Fed was projecting. 5 more in 2025. And at that point, we were right on track. I thought, oh, yeah, okay, perfect. This is exactly what I've been suspecting would happen. The economy would slow down. We'd start getting rate cuts. Gold would move above, break out of its range, tack on 10%, which things often do when they break out. And then instead, all of a sudden, the data seems to get a little bit better. And by the September FOMC meeting, not only are any hints of rate cuts gone for the remainder of this year, we start talking about rate hikes. And future rate cuts for next year get cut from 4 to 2. And, what does gold do? It goes down instead. Now it has since rallied as things have gotten softer again. And even the market, Fed funds futures, is starting to pull rate cuts forward again and starting to talk about 3 or 4 for next year. So now all of a sudden we're right back to where we were in June. It's just like we lost for 5 or 6 months that we're not going to get back. which again is what a lot of people feel like that have been holding gold for the last 10 years. So I still expect the economy to continue to weaken. I expect the Fed to respond to that because that's what they've done consistently over the last 15 years since the paradigm changed, toward QE and zero bound interest rates and the like. And I think that is shown in price with a rally in the first half of the year that does what I thought the back half of this year would do. Get above 2,100, tack on 10%, and should be a good time for everybody.
Hemke's predictions hint at a promising future for precious metals, with expectations of a gold rally and silver's upward trajectory. Despite recent signs that the Federal Reserve might be done raising interest rates, investor confidence wavered with releasing the minutes from the last meeting, making gold more attractive. What strategies will you employ to navigate this intricate system of gold, silver, and mining shares? Share your thoughts in the comments section below. If you find this video informative, don't forget to support our channel and turn on notifications to stay informed about our latest videos. See you in the following video.